Hello, in this video I wanted to look at the S&P 500 PE ratio. This is a measure that looks at the price of stocks versus the earnings the actual company is producing. And you can see going back to 1870 that it's been fairly stable. Low values would be this 5 to 10 range down here. Upper values are about 20 to 25. That would be this area here. And over the last 30 years, we've seen some elevated levels, but right now we're at 28.4, and this is on the S&P. And that's one of the highest readings we've actually seen prior to a major price decline. So we're going to talk about that. A high PE doesn't necessarily mean we're going to see a stock price crash, although it can sometimes indicate that. So these really high values have actually occurred once stocks have already been declining and earnings decline. And when earnings decline, that's when you tend to get the really big spike in PE, because prices may have fallen a little bit, or they may still be going up, or they may stay the same. But when those earnings decline, if they drop by 50%, all of a sudden those PE ratios can double. And it also takes time. Earnings releases are released quarterly, so it takes some time for lower earnings to be reflected in PE, and then we get these spikes. So the prices have already begun declining, but then you get the earnings decline that follows as the economy kind of slows down, and then you get these spikes in PE. So the spike in PE doesn't necessarily happen prior to the crash. It's often coincidental and even sometimes late. And so we're seeing a very high PE with earnings that are pretty stable. And we can see S&P 500 earnings here. These are all on multiple.com. So you can see we've been going up in earnings, just a little bit of a decline there, but not much compared to, let's say, 2009, which was the financial crisis, or following, way back here in the 1920s or the 1930s. So that's the PE. We can also look at inflation-adjusted PE. This is called the Shiller PE, and we can also see that we're at pretty close to some of the highest readings we've ever seen on that. So we're seeing overvalued stocks, and this doesn't just apply to the S&P 500. If we look at this one's at worldperatio.com, and this one uses the VTI ETF, which currently holds about 3,700 US stocks, so it's a very most stocks in the US, and it too, at one of its highest readings since going back to 1995. That includes some of the big stock crashes, the 2000, the 2009, and just a very high PE. So what does this mean for investors? Well, we're definitely overvalued, kind of in one of those historically high ratios. And again, that does not necessarily mean stocks will crash, but it means if you are buying stocks right now kind of as a long-term investor, we're paying a very high price. So earnings can drop, or the PE can drop and become more normalized in a couple different ways. You could have stock prices decline a little bit, go up a little bit, or stay pretty flat, but earnings increase more. So if earnings increase more, now all of a sudden those prices are lower relative to those earnings, which are increasing. That would decrease the PE ratio and potentially bring it back down into a more normal range. Or we could have prices decline. If you have a big price decline, then and earnings stay somewhat similar, or maybe just drop a little bit, then that could also bring PE down. What would cause PE to spike, which is what we see in these situations, here, and during COVID, is the earnings drop. So COVID happened pretty recently, and you may remember a lot of companies had to basically shut down. Think of restaurants, airlines, cruise lines. So they had money coming in, their stock price is at whatever it's at. But even if that stock price declined 50%, but their earnings go to zero, that basically makes their price to earnings ratio infinite, right? Because they're not bringing in any earnings, or they're negative earnings versus still a positive share price. So that's what causes these spikes. And the spikes actually happened after the price was already declining. So if we go to the very top here, like 2008, so March 2009, it hit 119 PE ratio. You can see that date up there, March, kind of mid to late 2009. If we go to the chart, this is just an S&P 500 chart. So by mid 2009, March, September, you can see the prices are already starting to rebound, but there was still the fallout from the bank failures, the mortgage crisis, and so companies were starting to report lower earnings as an aftermath of that, but stock prices were already starting to rise. So we actually saw the highest PE after the decline had already fallen. So the decline kind of started, let's say, here in late 2007. So if we go to late 2007, the PE then was about just below 25. Well, 21, let's say, at December 2007. You can see at the top there, the number up here. December 2007, 21. So a little bit elevated, but then it really spiked later down the road once the earnings of a lot of companies came to fruition. And if you've seen the movie The Big Short, you know what sort of caused this big decline was overpriced housing, lots of fraud going on in the housing market, and that eventually hit the banks, which then hit other companies because they couldn't borrow, and basically caused what we call a financial crisis. These other lines, you can ignore these red and green lines and these out and invested things, that's for something else. But so we see the decline happen before the PE really spikes, but it was still elevated prior to that spike. It was around, above 20. Let's go back to 2000, because that's a little bit of an interesting scenario. So 2000, we kind of peaked later in 2002, so like October, November, we were already starting to decline. If we go to, and that was of the year 2000. So if we go to the year 2000, toward the end, we were elevated. We're at about 27.55, which is very similar to where we are now. Now, at that point, stocks started to decline right around here. But the PE still continued to spike because now, if you remember the dotcom or you've read about it, a lot of these companies had, kind of puffed up earnings related to technology, yet ultimately they didn't end up coming to fruition. So earnings plummeted, and stocks didn't fall as quickly as those earnings fell. So you actually, as the price was declining, we actually saw an increase in the price to earnings ratio because earnings decreased at a faster rate than price. The same thing happened during COVID. So that was this little blip here where we see, in February, prices start to decline, February of 2020. So let's go to that. So March is pretty close. Let's see if we can get right on the number. No, right about, so March 2020. PE, again, pretty high. It's at about 25. But at this point is where stock prices started to decline. And again, we see that spike in PE, which happens after the price has already started to decline. So prices are already dropping here, and PE keeps going up, because even though this was an accelerated or a very quick decline, all those companies, had to shut down, some of them for months, or saw a dramatic decrease in their earnings, which plays out over the next 3 months, 6 months, a year down the road. So prices had already started to recover when that price peaked. So that's just a little bit of information on the PE. Yes, we're at a very high level, and high levels have sometimes correlated to declines in the stock price. But if that happens, if stock prices decline, it's likely that the PE might actually go up, because usually when kind of bad news hits the market, earnings also tend to fall because people stop spending, companies aren't making as much money, so earnings decline. As earnings decline, if they decline more than the stock prices have declined, you see the PE spike. Either way, just something I noticed that, we're pretty much at one of the highest levels we've ever seen. Stocks overvalued, so you can take from that what you will and consider how you want to invest in this environment.